In the Chapter 3 screencast, I'm going to cover adjustments, and you'll read a lot about adjustments in Chapter 3. Adjustments are needed to comply with the revenue recognition and matching principles. If we don't make adjustments, we probably will be in violation of both of those principles, and those are pretty basic accounting principles. One reminder I want to provide is that cash is never part of an adjusting entry. So if you're double checking what your adjusting entry is, you need to make sure there's never any cash in there. If there's cash in there, you've made a mistake. So adjusting entries will include an asset or liability and an increase to either a revenue or expense account. So that's another way you can check to make sure that your adjusting entry is appropriate. What I'm going to do down here below is cover the types of adjusting entries and then provide some examples, and we can talk through those. I hope this will be helpful for you in understanding adjustments. So there are two basic types of adjustments. The first type is prepaids, so we're going to cover those first. Where there's a prepaid, cash is received or paid before recognizing the revenue or expense. So there's a prepayment of the cash before the revenue is recognized or the expense is incurred. There are two types of prepaids. The first is a prepaid expense. And the example I've got here, we signed a lease for office space and we're required to pay 3 months rent in advance. So first we're going to see the entry to record the actual payment. And we're going to record a debit to prepaid rent for $3,000. This is an asset. This is an asset until we use up this amount. And again, because we're paying the rent in advance, we're not using all the rent right away. So we're debiting prepaid rent and we're crediting cash because cash is going out the door. Next, we're going to see the adjusting entry. So you'll notice on prepaids, we've got two types of prepaids here we're going to talk about. The adjusting entry is recorded after the initial entry with the cash. So this is the initial entry. This would not be considered an adjusting entry. This is the adjusting entry down here. So we've paid out the cash. We've recorded the $3,000 in prepaid rent, which is an asset. And then over the next 3 months, which is basically the time period that we're going to incur the rent expense, we're going to make this adjusting entry each month. Debit rent expense for $1,000 and credit prepaid rent for $1,000. The result of this adjusting entry for the next 3 months, and again, we would need to make this for the 3 subsequent months. At the end of the 3-month period, expense has been recorded in the proper months. That's what we're trying to end up with. We're trying to honor the matching principle and record the expense in the proper periods. The second type of prepaid adjustment is called unearned revenue. An example, we agreed to do a catering job next month and required that the $1,000 fee be paid in advance. So we're going to see an entry to record the cash received. Again, this was the advance payment of the fee. We debit cash and we credit an account called unearned revenue. This is a liability until the revenue is earned. And a way I like to think about this is if you did something to that the event would not go on, you would have to refund this amount back to the customer until the event actually took place. So we can't record it as revenue because we haven't done the job yet, and it might potentially be refunded. So we need to keep it in a liability account. So this is the entry when the cash is received. And then again, because it's a prepaid, the adjusting entry comes afterwards. The adjusting entry when the event occurs, we're going to debit unearned revenue. We're going to take that $1,000 that we put in, we're going to take it out, and we're going to move it and credit catering revenue because now we can recognize the revenue. And the result of this is that revenue is recorded in the month earned. So we may have received the cash ahead of time, but we want to honor the revenue recognition principle to make sure that we're recording the revenue in the proper period. The second type of adjustment is called an accrual, and we've got two types of accruals that we're going to talk about. So if you recall up here with prepaids, the cash is received or paid before recognizing the revenue or expense. With accruals, cash is received or paid after recognizing the revenue or expense. So all these adjusting entries are related to the timing of cash and the recognition of the revenue or expense. With prepaids, the cash is received or paid before we recognize the revenue or expense. With accruals, the cash is received or paid after recognizing the revenue or expense. We have two types of accruals. The first is accrued expenses, and the example I have here is employees worked 5 days in June and will be paid in July. So with accruals, the adjusting entry comes first. If you recall up here with the prepaids, the adjusting entry came second. So accruals, we make the adjusting entry first, and in this case, we're going to debit wage expense for $2,000, and we're going to credit wages payable $2,000. And again, this wages payable is a liability until it's paid, because we owe this to the employees. They've done the work, and we've promised to pay them. Down here, when the wages are paid, we're going to make this following entry. We're going to debit wages payable, $2,000. We're going to take it out because we're paying it now, and we're going to credit cash. The result of these entries, expenses recorded in June when the work was done. So we want to, again, honor that matching principle and get the expense recorded in the proper period, even though there's a timing difference when the cash is paid out. The second type of accrual is called accrued revenue. In my example here, we agreed to provide services beginning in August and will be paid in September. So again, because this is an accrual type adjustment, we're going to make the adjusting entry first. In this case, I added some dates just to help us frame everything properly. So at the end of August, we would be debiting accounts receivable $5,000 and crediting service revenue $5,000. Because again, this is when we actually provided the services. So we want to record that revenue in the proper period. This accounts receivable is an asset, and it's an asset until we receive the cash, because the customer owes us that money. They've promised to pay us. Subsequently, when the cash is received, we're going to record this adjustment. So this is not an adjusting entry here with cash. This is the adjusting entry up here. This records the revenue on our books. This simply records when the cash is received. We debit cash, $5,000, and we credit accounts receivable. Because again, we can zero out this accounts receivable now because we have now received the cash. And the result here is that revenue is recorded in August, which is the period earned. Hope this has been helpful, and we'll have some subsequent screencasts. Thanks.